The average investor who panic sold during the Gulf War in 1990 lost $43,000 in future gains compared to someone who simply stayed the course. And right now, in 2026, millions of people are about to make that exact same mistake. Let's talk about what's actually happening. The Iran conflict has pushed Brent crude past $120 a barrel. The S&P 500 has swung more than 2% in a single day 14 times in the last 6 weeks alone. Defense stocks are ripping, tech is getting hammered, and if you've been on Reddit or Twitter lately, you've seen the posts, people liquidating their 401ks, moving everything to cash, genuinely asking if they should pull money out of the bank. The fear is real. I'm not going to tell you it isn't. When you see missiles flying and oil spiking and your portfolio dropping 5 figures in a week, every instinct in your body screams, do something, sell, hide, protect what's yours. And that instinct? It's completely natural. But historically, it's also the single most expensive financial decision you can make. Here's what the data actually shows. JP Morgan studied 20 major geopolitical crises from Pearl Harbor through the Russia-Ukraine war. In 19 out of 20 cases, markets recovered their losses within an average of 47 trading days, not years, days. The research team at Vanguard found nearly identical results, and a 2024 study from the National Bureau of Economic Research confirmed that investors who sold during geopolitical shocks underperformed buy-and-hold investors by an average of 8% annually over the following 3 years. These aren't opinions, these are patterns backed by decades of evidence, and at Passive Edge that's exactly what we follow. Evidence, not emotions. So here's what I'm going to give you. 5 concrete, actionable strategies to protect your money during this war economy, without blowing up your long-term wealth in the process. No doom and gloom, no goldbug conspiracy theories, just a clear-headed playbook you can actually execute this week. Strategy number 1. Audit and right-size your emergency fund. Before you touch a single investment, you need to know your baseline is secure. During geopolitical uncertainty, the standard advice of 3 to 6 months of expenses isn't enough. You want to push that to 6 to 9 months, especially if you work in an industry directly affected by energy costs, supply chains, or international trade. Calculate your true monthly burn rate, not your income, your actual non-negotiable spending. Rent or mortgage, utilities, groceries, insurance, minimum debt payments. Multiply that by at least 6. If your emergency fund falls short, the move is to redirect new investment contributions temporarily, not to sell existing positions, until that cushion is solid. Park it in a high-yield savings account or a short-term treasury bill fund, yielding around 4.8% right now. This is your financial oxygen mask, put it on first. Strategy number 2, rebalance your portfolio, don't rebuild it. There's a massive difference between panicking and rebalancing. Panicking means selling everything and going to cash. Rebalancing means checking whether the war economy has shifted your asset allocation away from your target. Here's what I mean. Let's say your target allocation is 70% stocks, 20% bonds, 10% alternatives. If the stock market drop has pushed you to 62% stocks and your bond allocation has crept up to 26%, you're now taking less risk than you intended, which sounds safe but actually costs you during the recovery. The move is to sell what's become overweight and buy what's become underweight. You're essentially buying stocks on sale, funded by your bond gains. This is systematic, this is rational, and this is exactly what institutional investors are doing right now, while retail investors are running for the exits. Strategy number 3. Add smart measured commodities exposure. Oil is above $120. Gold has broken $2,900 an ounce. Natural gas is surging on supply chain fears. If you have 0 commodities in your portfolio, you're fully exposed to the inflation side of a war economy without any hedge. But here's the key, you don't chase commodities after they've already spiked. A reasonable approach is to allocate 5 to 10% of your portfolio to a broad commodities ETF, something like GSG or DJP, which gives you diversified exposure across energy, metals, and agriculture, rather than making a concentrated bet on oil alone. If you already own energy stocks or commodity producers, check your actual exposure before adding more. The goal is balance, not speculation. You want this slice to act as a shock absorber, not a lottery ticket. Strategy number 4. Lock in and diversify your income streams. War economies create inflation. Inflation erodes purchasing power. The best defense isn't just growing your portfolio, it's making sure money keeps flowing in from multiple directions. If you've been sitting on a side income idea, now is the time. Digital products, freelance consulting, dividend-focused ETFs, even Treasury I-bonds, which are currently yielding above 5% and are literally designed to track inflation. The point is to reduce your dependence on any single source of income, including your employer. During the 2022 energy crisis in Europe, workers with diversified income streams reported 40% less financial stress than those relying solely on a paycheck, according to a study by ING Bank. Passive income isn't just a nice-to-have during a war economy, it's a structural advantage. Strategy number 5, implement an anti-panic protocol. This is the most important one, and it costs you nothing. Write down your investment plan, your target allocation, your time horizon, and the specific conditions under which you would actually change your strategy. Then make a rule. You do not make any portfolio moves on days when the market drops more than 3%. You wait 48 hours. That's it. Behavioral finance research from Dalbar shows that the average investor underperforms the S&P 500 by roughly 3% per year, and almost all of that gap comes from emotional buying and selling. Your written plan is your anchor. When the headlines are screaming and your gut says sell everything, you pull out that document and follow the plan. Not your feelings, the plan. Let me show you how this plays out in practice. Take someone we'll call David. He's 38, has a $220,000 portfolio, and was 70-30 stocks to bonds at the start of this year. By mid-2026, with the conflict escalating, his stocks had dropped 15% while his bonds gained 4%. His allocation had drifted to 63-37. His emergency fund covered 4 months. Here's what David did. First, he redirected $500 a month from new investments into his high-yield savings until he hit 6 months of expenses. Second, he rebalanced, selling some bond position and buying equities at a discount to get back to 70-30. Third, he added a 5% allocation to a broad commodities ETF, funded by trimming his overweight bond position. Fourth, he started a small consulting side gig doing 2 hours a week, bringing in an extra $800 a month. And fifth, he wrote his plan down and taped it next to his monitor. 3 months later, when oil briefly touched 135 and the market dropped another 6% in a week, David didn't sell. He followed his protocol, and by the time markets stabilized, his portfolio had recovered to $212,000, while his co-worker who sold near the bottom was still sitting in cash, waiting for the courage to get back in. Here are 3 things you can do today, right now. 1. Open your bank account and calculate your exact emergency fund coverage in months. If it's below 6, set up an automatic transfer this week. 2. Log into your brokerage and compare your current allocation to your target. If anything is off by more than 5%, schedule a rebalance. 3. Write your investment plan on paper. Target allocation, time horizon, and your 48-hour rule. Put it somewhere you'll see it. Look, war is scary. Economic uncertainty is uncomfortable, but the data is overwhelmingly clear. The investors who build wealth through these periods aren't the ones who predict what happens next. They're the ones who prepare, stay disciplined, and refuse to let fear make their financial decisions. That's the edge. If this gave you some clarity, hit subscribe. We put out videos every week on building real financial independence, even when the world feels like it's falling apart. Drop a comment and let me know. What's the one move you're making this week to strengthen your financial position? And if you want to go deeper on building passive income streams that hold up in any economy, watch this video right here. I'll see you in the next one.